There's a silent mistake people make with their bank accounts every day. It looks harmless, even smart, but it can trigger a rule tied to $10,000 that puts you on a federal radar, and the penalties can reach $80,000. Most people only find out after the damage is done. Before July 1st, you need to understand exactly how this works. Here's what banks don't explain, and how to stay safe. Let me walk you through what the $10,000 bank rule actually says, because almost every American has heard a version of this rule that is incomplete, partially wrong, or missing the most dangerous part entirely. The rule originates in the Bank Secrecy Act of 1970, codified at 31 U.S.C. Section 5313. Under that statute, any financial institution that receives a cash transaction of $10,000 or more in a single business day is required to file a Currency Transaction Report, a CTR, with the Financial Crimes Enforcement Network, which is the federal agency known as FinCEN. The CTR is not a penalty. It is a disclosure. It is filed automatically by the bank. The customer does not sign it, does not receive a copy, and in most cases is never told it was filed. That part most Americans have heard. Deposit more than $10,000 in cash and the bank files a report. What almost no American has been told is the second rule, the rule that lives directly underneath the $10,000 threshold, and that is responsible for the vast majority of federal penalties assessed against ordinary civilians. That second rule is called the structuring prohibition. It is codified at 31 U.S.C. Section 5324, and it makes it a federal crime, not a civil infraction, a federal crime, to break up cash transactions specifically to avoid triggering the $10,000 CTR reporting requirement. The law calls this structuring. Federal prosecutors and IRS criminal investigators call it smurfing, and the penalties for structuring are severe, regardless of whether the money involved came from any illegal activity whatsoever. Let me say that again because it is the part that almost no American has been told. You can be penalized for structuring even if every dollar you deposited was completely legitimate, even if you paid taxes on it, even if it came from your paycheck, your pension, your savings account, or the sale of your personal property. The structuring prohibition does not require illegal source funds. It requires only that a federal examiner determine that you broke up transactions to avoid the reporting threshold. The civil penalty for structuring is up to $10,000 per violation. Each separate transaction can be treated as a separate violation. And under the Coordinated Enforcement Initiative that FinCEN and the IRS Criminal Investigation Division launched in January of 2026, accounts showing patterns of sub-$10,000 cash deposits over a trailing 24-month period are being flagged for review at a rate that is approximately 4 times higher than the 2022 baseline. That is not a rumor. That is enforcement data that was described in the FinCEN advisory published in February of 2026, and that has been largely ignored by mainstream financial media because it applies primarily to small depositors, retirees, small business owners, and self-employed individuals, rather than large institutional clients. The $80,000 penalty figure is not hypothetical. It represents 8 separate structuring violations, 8 sub-threshold deposits over an examination window, assessed at the maximum civil penalty per transaction. For a retiree who deposited cash from rental property income, from a part-time business, or from occasional sales of personal items 8 or more times over 2 years in amounts just below $10,000, that exposure is real, it is calculable, and it is waiting. Now let me walk you through the hidden trap, the specific pattern that is catching ordinary Americans who have never structured a transaction intentionally in their lives. The hidden trap is called pattern-based structuring inference, and it works like this. Federal examiners do not need to prove that you consciously decided to keep deposits below $10,000. Under United States v. Rybicki and subsequent circuit court interpretations, the government can establish structuring intent by demonstrating a consistent pattern of sub-threshold deposits combined with evidence that the depositor had knowledge of the $10,000 reporting requirement. That second element, knowledge of the reporting requirement, is where the trap closes on ordinary Americans. Because federal courts have held that knowledge of the reporting threshold can be inferred from common public awareness. The $10,000 rule has been widely reported in news media for decades. The IRS includes references to it in public guidance. Banks post disclosures near teller windows in many states, and in several circuit court decisions, judges have held that a depositor who is an adult American citizen with normal access to financial information can be presumed to have constructive knowledge of the reporting threshold. What this means in practice is that a retiree who has been depositing $8,500 in cash from their part-time landscaping business every 2 to 3 weeks, not because they wanted to avoid reporting, but simply because that is how much cash they accumulated between trips to the bank, can face a structuring determination based entirely on the pattern of those deposits. No criminal intent required, no illegal source funds required. Pattern plus inferred knowledge equals federal exposure. The second layer of the trap is account aggregation. FinCEN examiners do not look at single accounts in isolation. They look at all accounts held by a single taxpayer identification number across all financial institutions. If you have a checking account at one bank where you make regular deposits of $7,000 to $9,000, and a savings account at a second bank where you occasionally deposit $4,000 to $6,000, and the combined deposits in a single month across both institutions exceed $10,000 on multiple occasions, the examiner can construct an aggregated structuring case, even though neither individual account shows a pattern that would trigger review on its own. Almost no banking customer has been told that their accounts at different institutions are being reviewed on a consolidated basis. Almost no retiree knows that the $8,500 cash deposit they made last Tuesday is being evaluated alongside deposits they made at a credit union 2 weeks prior. And the IRS data matching infrastructure that was significantly expanded under the Inflation Reduction Act of 2022 has made cross-institution pattern analysis faster and more comprehensive than it has ever been in the history of American banking regulation. That is the hidden trap. Not a single large deposit, not a deliberate criminal act, a pattern, innocent, habitual, entirely explainable, that a federal algorithm flags and that a federal examiner then investigates without warning, without prior notice, and without any requirement to give the account holder an opportunity to explain before issuing the penalty. Now let me walk you through the specific deposit patterns that federal examiners are flagging in 2026 and that every American needs to understand before July 1st. Pattern number 1, recurring sub-threshold deposits. Any pattern of cash deposits that occurs on a regular schedule, weekly, bi-weekly, or monthly, in amounts consistently between $7,000 and $9,999, is the highest priority flag in the current FinCEN examination matrix. The consistency of amount combined with the consistency of timing is treated as evidence of deliberate threshold management regardless of the actual source of the funds. Pattern number 2, incremental deposits across multiple days. A depositor who brings $14,000 in cash to the bank and deposits $7,000 on Monday and $7,000 on Wednesday has split a single transaction across 2 days. Federal examiners can aggregate same-week deposits from the same source into a single transaction for examination purposes. If the total exceeds $10,000, both deposits become part of a potential structuring determination. Pattern number 3, joint account splitting. A married couple who each holds a separate individual checking account and who each makes regular cash deposits in amounts between $5,000 and $9,000 from the same household income source, rental property, family business, retirement withdrawals converted to cash, can be treated as coordinated structures even though neither individual account exceeds the threshold individually. The IRS examines household-level transaction patterns for taxpayers who file jointly. Pattern number 4, business-to-personal transfer deposits. A self-employed retiree or small business owner who withdraws cash from a business checking account and deposits it into a personal checking account in amounts below $10,000 is creating a transaction chain that FinCEN examiners treat as a structuring red flag, regardless of the legitimate business purpose. Cash movement between accounts you own, for operational reasons you can fully document, can still trigger a structuring review if the amounts fall consistently below the reporting threshold. Pattern number 5. Cash deposits following large ATM withdrawals. If your bank records show a pattern of ATM withdrawals in the $500 to $3,000 range, followed within 2 to 5 days by cash deposits of $7,000 to $9,500 at the same or a different institution, FinCEN's pattern matching algorithm interprets this as cash accumulation and controlled redeposit, a common structuring technique used by individuals who receive irregular cash income and aggregate it before banking. Any single one of these patterns in isolation may not result in a penalty. But in combination, and the 2026 Enforcement Initiative specifically looks for 2 or more concurrent patterns in the same account, the probability of an examination notice rises dramatically. And once the examination notice is issued, the burden of proof shifts. You must demonstrate that the pattern was not intentional, you must produce documentation, and you must do it within the response window specified in the notice, which is typically 30 days. To make this real, let me tell you about a retired contractor named Robert. Robert is 68 years old. He lives in Tucson, Arizona. He spent 31 years running a small residential construction and renovation business, mostly kitchen and bathroom remodeling, some roofing work, a handful of larger additions over the years. He sold the business in 2021 when his knees gave out, and he retired with a modest savings account, a paid-off house, and approximately $210,000 in a rollover IRA from a SEP plan he had maintained through his business. After retirement, Robert kept doing small cash jobs. Not a business exactly, just occasional work for neighbors and former clients. A weekend helping someone frame a room addition. A few days replacing a fence. Odd jobs that paid $500 to $3,000 in cash. He reported all of it on Schedule C every year. He paid self-employment tax on every dollar. He was, by every measure, a completely compliant taxpayer. Every 2 to 3 weeks, Robert would accumulate $6,000 to $9,000 in cash from these small jobs, drive to his regional bank, and deposit it into his personal checking account. He had done this in some form for 11 years, first while the business was running, then in retirement. He never thought about the $10,000 rule. He was not avoiding it. He simply deposited what he had when he had enough to make the trip worthwhile. In October of 2025, Robert received a letter from the IRS Criminal Investigation Division, not from the IRS Taxpayer Services Division, from IRS Criminal Investigation. The letter informed him that his account transaction records had been reviewed as part of a routine financial institution examination and that his deposit patterns over the period January 2023 through December 2024 had been identified as potentially consistent with structuring activity under 31 U.S.C. Section 5324. The letter listed 8 specific deposit transactions. All of them were between $6,200 and $9,400. All of them were cash. All of them were income Robert had reported on his tax returns and paid taxes on. The letter proposed a civil penalty assessment of $10,000 per transaction, a total proposed penalty of $80,000. It gave Robert 30 days to respond. Robert had no idea what structuring was. He had never heard the word used in a banking context. He called his accountant, the same CPA who had filed his taxes for 14 years. His accountant had never handled a FinCEN structuring case and referred Robert to a tax attorney. The attorney quoted a retainer of $8,500 to begin the response process. Robert ultimately paid $24,000 to resolve the case, $15,500 in penalties after a negotiated reduction based on demonstrated good faith and documented legitimate income, plus $8,500 in legal fees. He did not go to prison. He was not charged criminally. But he lost $24,000, more than 11% of his entire retirement savings, for depositing his own legitimately earned, fully taxed income in amounts that a federal algorithm decided looked suspicious. The outcome could have been different. If Robert had understood the structuring rules before October of 2025, if he had restructured his deposit habits, documented his income sources, and placed a voluntary compliance note in his account records, the examination might never have been elevated to penalty proceedings. And if he had known about the voluntary disclosure path that I am going to describe in a few minutes, he would have had a structured legal mechanism to resolve the issue before it became an $80,000 proposed penalty. Robert recovered. He still does occasional cash jobs. He now deposits every cent at the teller with a written deposit memo that notes the income source. He has not received another letter. But he is one of thousands of retirees who discovered the structuring trap the expensive way, after it was already too late to use the proactive protection moves that were available to him. Now let me walk you through the 4 most common mistakes Americans make when they learn about the structuring rules. Because understanding the rule is not the same as protecting yourself correctly. Mistake number 1, immediately changing deposit behavior without documentation. The instinct when you hear about structuring rules is to start depositing over $10,000 in cash to trigger the currency transaction report, and thereby prove you are not hiding anything. That instinct is understandable and completely wrong. A sudden shift from consistent sub-threshold deposits to consistent over-threshold deposits can itself be flagged as evidence of recent knowledge acquisition, meaning the examiner may interpret the behavioral change as confirmation that you were previously aware of the threshold and deliberately avoiding it. Any change in deposit behavior must be accompanied by contemporaneous written documentation explaining the change and the legitimate reason for it. Mistake number 2, assuming your tax compliance protects you from structuring penalties. Robert made this mistake. He was a perfect taxpayer. Every dollar reported, every tax paid. It did not matter. The structuring prohibition is a banking regulation, not a tax regulation. The IRS enforces it through FinCEN coordination, not through your 1040. A clean tax record is a mitigating factor in penalty negotiation. It is not a defense against a structuring determination. Mistake number 3, waiting for a letter before taking action. The examination process that leads to a structuring penalty letter typically takes 12 to 18 months from initial flag to notice issuance. By the time you receive the letter, the decision to pursue civil penalties has already been made at the examiner level. The 30-day response window is for challenging the amount, not for preventing the assessment. Prevention requires action before the letter arrives, not after. Mistake number 4, discussing the issue with your bank teller. This is a critical error that several of Robert's neighbors made when they heard about his case. A bank teller is a mandatory reporter under the Bank Secrecy Act. If you walk up to a teller and say anything that indicates you have concerns about your deposit patterns in relation to federal reporting requirements, that conversation can be logged as a suspicious activity report, a SAR, which escalates your account for immediate review. Any concern about your deposit history should be discussed only with a licensed tax attorney or a certified public accountant who works under attorney-client privilege protections, never with bank staff. Here are the 5 protection moves every American needs to complete before July 1, 2026. Protection move number 1, pull your own deposit records for the past 24 months. Log into every bank account and credit union account you hold and download your complete transaction history going back to January 2024. Print it or save it as a PDF. Go through every cash deposit and note the amount, the date, and the source of the funds. If you see a pattern of recurring cash deposits in amounts between $7,000 and $9,999, you need to take the remaining protection moves immediately. Protection move number 2, create a written income source log. For every cash deposit you have made in the past 24 months, write a 1-paragraph explanation of where the money came from. Rental income collected in cash, sale of personal property, cash earnings from self-employment, gifted funds from family, accumulated cash from regular paycheck withdrawals for household expenses, Date each entry, sign it. Keep it in a file with any corroborating records, invoices, sales receipts, gift letters, copies of checks converted to cash. This documentation does not eliminate the pattern, but it creates an evidentiary record of legitimate intent that a tax attorney can present in response to an examination notice, and that can reduce or eliminate civil penalties under the good faith exception recognized in Treasury regulation and established by the IRS Penalty Abatement Guidance in IRM 20.1.1. Protection move number 3. Contact a tax attorney or enrolled agent who specializes in FinCEN compliance, not your general tax preparer, and request a 30-minute consultation to review your deposit history. The cost is minimal. The protection it provides is substantial. A specialist can assess your specific pattern against the current examination matrix and advise whether a voluntary disclosure filing is appropriate in your situation. Protection move number 4. If you have cash from legitimate sources that you routinely deposit in amounts below $10,000 for logistical reasons, not for avoidance, change the deposit to a single consolidated amount above $10,000 and file the CTR through normal teller processing. Document the change in your income source log with the date and the reason. This resets your account's pattern profile going forward. Combined with the written documentation of prior deposits, it demonstrates a consistent posture of compliance rather than avoidance. Protection move number 5. Review your accounts at every financial institution where you hold accounts. Banks, credit unions, brokerage accounts with cash deposit features, online banks. Make a complete list. Confirm that your contact information, address, and identification records are current at each institution. If a federal examination notice is mailed to an outdated address, the 30-day response window runs regardless of whether you receive it. An expired response window eliminates your ability to contest the penalty amount before it becomes final. Now let me tell you about the bonus move that almost no American banking customer has been told exists. It is called the Voluntary Self-Disclosure Pathway under FinCEN's Bank Secrecy Act compliance framework. And it is the single most powerful tool available to an ordinary American who believes their deposit history may have inadvertently created structuring exposure. Here is how it works. FinCEN maintains a formal voluntary self-disclosure program that allows individuals and businesses to proactively report potential Bank Secrecy Act violations before a federal examination identifies them. Under the program, a disclosure submitted before the government opens a formal investigation receives significantly more favorable treatment than a disclosure submitted after examination proceedings begin.